Welcome back to Switzerland. Sky News Money. Our stock market is down about 15% since its high, and while some of the big cap companies have copped it, what's happened to small cap companies, and is there some real value there? Simon Conn is Senior Portfolio Manager at Investors Mutual, and small cap companies, that's his beat. So let's just see what he likes right now. Simon, thanks for joining us.
Pleasure, Peter.
So I know we had a lot of fund managers on this show 3 or 4 months ago. They were saying, oh, there's no value, there's no value. And okay, the market's sold off. Is there value now?
Yeah, there's value, but I think you've got to be selective. I mean, obviously, we've seen a big pullback, so, you know, we do see some value in some of the stocks, but I think it is an environment where you have to be very, very selective.
Yeah. Okay, so how important to you is the macro scene in selecting small cap companies that you like?
Look, we're a bottom-up fundamental stock picker. So, I mean, we look at the fundamentals of the companies that we're investing in. But obviously, you've got to take a view on the macroeconomic situation and understand where you are in the cycle. But at the end of the day, it's really about buying good quality companies that can do well over the next 3 to 5 years. And that's what we focus on in Investors Mutual. Okay.
So, what was your perception of, when we nearly got to 6,000 on the ASX 200 index, and then the actual fall we've seen since? Do you think the fall's been an overreaction, or fair call?
Look, to be fair, Peter, a lot of the companies we invest in, I mean, have pulled back in price, but haven't seen as dramatic a pullback in price as we've seen with the index. Yeah. And so what we're seeing with the index, and you know, we've talked before about the domination of the banks and the resources sector. Yeah. So those two sectors are really under a lot of pressure at the moment, and that's what's led to a lot of the pullback in the market. You know, the good quality companies, the GWAs, the Steadfast, the PACs, you know, the companies I can talk about all day, they've pulled back in price to an extent, but they haven't dramatically reduced. And so, you know, what we've been doing is selectively buying those sort of stocks when they fall into our buying range. Yeah.
Okay. So, can you give us the company that you think that has best, the one you like the most and has fallen the most in recent times?
As I said, I mean, not a lot of them have fallen, but I mean, look, today we were buying.
That's because your selection was so brilliant. I know that, but come on, there's got to be at least one.
Look, I think you know, for one, you know, one stock I bought today was Shopping Centres Australia. Yeah. It's a REIT, but it was spun off by Woolworths just over 2 years ago. Yeah. Its portfolio largely 60% of their rent roll comes from Woolworths, and they own some of the key assets that underpins the Woolworths shopping centre empire in Australia. Yeah. And if you think about Woolworths, the two key things that their business has is a great logistics business and a great real estate business. And when you buy Shopping Centres Australia, you're effectively buying some of the best regional shopping centres in the country. Yeah. So the rents grow at 2 to 3%. And it's yielding about 6.5% at current prices. So I think, you know, investors, you know, can't go too far wrong in buying that sort of stock. Okay, but you know, I've talked to your boss and colleague Anton Taliaferro, and is he over the moon at Woolworths' performance as a company in its own right? Look, you know, obviously Woolworths have had their issues, Peter. Yeah. But look, it's not all dire. I think, you know, we've seen Gordon Cairns now instilled as chairman there. Yep. And I think that's going to lead to a reinvigorated management team. We met the new MD, or the managing director of the supermarket division, just recently, and he looks like a really good operator, good solid-boned operator. And as I said, you know, the two fundamentals of Woolworths being the logistics business and the real estate business, they're not broken. Yeah. It still is the largest supermarket retailing business in the country. It's the scale player. It's a little bit broken, for sure. There's a few things that they haven't done right. But fundamentally, it's not, you know, not catastrophic. It's not throw away the baby with the bathwater time.
I know you specialise in small caps, but is there anyone in your organisation saying Woolworths looks like good value now, or do they think it has to fall a bit further before that?
Look, Woolworths is a stock we own, and we're watching it very closely. Yeah. Obviously, the catalyst will be, and the key will be getting a very good management team in place with the new CEO, and then seeing what their plans are in terms of turning around the business. But fundamentally, I don't think it's that broken. It's really about executing. And as you would have heard many retailers come on this show before, retail is about detail, and it's just about doing a lot of little things right. And I think fundamentally the business isn't broken, and they can get it back on track.
Okay, let's talk about small cap companies that have a nice yield story, because we love yield, but we invariably will chase the big caps for yield. Are there small cap companies that are consistently good yield payers? And if so, name names.
Okay. So look, three companies that we like, you know, in the QVE portfolio and across the small cap companies products. One's Pact Group.
But explain what the QVE, because they might have thought you said QBE.
Fair enough. Some people make that mistake. So QVE is our new listed investment company, listed on the 22nd of August last year. So it's been listed now just over.
And what's the theme for that?
That's about investing outside the top 20 stocks in the market.
Yeah.
So I co-portfolio manage that with Anton, and we're looking to buy the best quality companies that we can across the market outside the top 20 with a minimum market cap of $200 million.
Yeah.
It's a long-term buy and hold strategy. It's not a trading business. But one of the companies we really like at the moment is Pact. Look, it's not a high growth business, but it is really well managed. It's Australia's largest rigids plastics manufacturer, run by Rafi Gaminder, and Brian Cridlin is the managing director. He was previously at Visy.
How do you spell that?
Which one? Cridlin?
Pact.
P-A-C-T.
Yeah, Pact.
Yeah. The code's
it's not a well-known company.
The code's PGH, but at $1.3 billion, it's not a tiddler, but it is a significant player in the rigids plastic market. It's the main player. And the thing that we like about Pact, firstly, it's the scale player in terms of rigid plastic, so it buys resins, it buys capital equipment, it's got the best in terms of executing in rigid plastics packaging. And secondly, the management team, Rafi Gaminder, Brian Cridlin, they have done, they've built this business through a series of reasonably priced acquisitions. The business itself is not high growth in an organic sense, but it generates very strong free cash flows. And as those free cash flows are applied to acquisitions, we think they can grow their business going forward.
And they must have a solid and reliable customer base.
Look, it's Australia's...
You wouldn't be backing them otherwise.
It's blue chip, as you get across Australia. Unilever, Procter & Gamble, Dulux, Fonterra in New Zealand. These are high-quality customers. And the product itself doesn't vary in demand. So whether it's shampoo or milk bottles, the demand is fairly stable, which again underpins a fairly stable and predictable earnings stream.
Okay, that's one. Pact. You said three.
Steadfast.
We're all ears.
Steadfast is the second company. It listed more recently. It's an insurance broking business. In fact, it's in the top 20 globally as in general insurance brokers, and it's the largest general insurance broking business in this country.
Where did they come from? Did they come from Victoria?
Oh, I'm not sure. I think it's a New South Wales business. Headquarters in New South Wales. Started life as a buying group. So Steadfast is a buying group for insurance brokers, over 500 brokers in the network. And they place their premiums with Steadfast, and then they place them with the underwriters and get better deals or collective buying power, and use the IP at head office in terms of a better management of the business. And we think they can grow going forward.
Why?
Because
what's the big appeal?
If you look at OAMS, which we owned many years ago, if you look at Ausbrokers and how they've performed over the years, there's a strong network of brokers who are independent at this stage, but will look to sell some equity stake in their business, and Steadfast, as the buying group that they buy through, are well placed to buy businesses. So on IPO, 500 of the brokers that place their premiums.
And these are insurance brokers?
These are general insurance brokers across Australia and New Zealand. About 50 of them came together in the IPO. And then since listing, they've bought more of those businesses, and we think they can grow going forward.
And being general insurance brokers are not going to be affected by the inquiry into insurance, the Trowbridge inquiry, which is affecting financial planners and
the life business.
Yeah, life business.
Look, and the good thing about general insurance is that it's a business that's increasingly becoming complex.
Yeah.
The lawyers can find new ways around the law, and litigation is a key part of mitigating your risks in business. So you need appropriate insurance cover. And you need to do that, you need to go to your insurance broker every year and make sure that you've got the right level of cover.
Yeah, good point.
And so, one of the things they're talking about at the moment is having the appropriate level of insurance cover for cyber risk, which is something that didn't exist 2 or 3 years ago. But if your records are hacked into and your client account, say you're a GP, are stolen, you're potentially...
Well, the Vodafone story was a huge story, wasn't it?
That's right.
Because of the security issues.
So the hacking issues. So the broker, so the trusted relationship, so the renewal rates are very high, over 90%, and that very sticky relationship.
Okay, so far so good. I'll give you a tick on both those two. What's your third one?
Okay, my third one's a New Zealand company. Just bought it recently. Don't take me the raised eyebrows. But Genesis Energy, you're going to think I'm a bit of an energy bun because we talked about energy developments last time. But Genesis Energy was the third of the 3 gentailers listed in New Zealand over the last 2 years. So it's an integrated electricity manufacturer effectively and
gentailer, they generate and they sell.
It's basically it. It's just like AGL in Australia.
Yeah.
Very strong market position. They've got about 37% share of the retail market. And basically they've got generation in terms of coal-fired, gas-fired power and run-of-the-river renewables portfolio as well.
Yeah.
Produces very consistent cash flows. And the reason I like the business is not just the yield, but the fact that it was, as the last of the businesses listed in New Zealand, it was the least... had the least corporate history, so if we think there's more cost-out opportunities. So if you look at the history of the business, since it's listed, management have continued to take costs out of the business and grow the earnings accordingly.
Yeah. These companies, a lot of us don't like these great names like AGL and Origin and stuff because there seem to be so many curveballs coming at those businesses. Like you've got the price of energy, which, well, the raw materials coming down, but there's a lot of competition to it as well. You've also got question marks about solar energy and the prospect of batteries and all that sort of stuff. Now, my feeling is, if I wanted to punt on these companies, if there are changes coming, they're more likely to buy the threats to their business. Is this something that you've thought about and you've come up with a better answer than me?
No, look, it's not punting, Peter. We're investing, so we've taken a long-term view in terms of the stock.
But we don't know. Well, when there's so many curveballs, you start thinking it's more like punting. Like Woolworths is easy.
Look, every equity comes with risk, Peter.
Yeah.
That's at the end of the day. I mean, you can buy Genesis on a price-to-cash flow multiple about 6 times, yielding 10% today. Which means, you're going to get your capital back over the next 10 years, effectively.
Yeah. What are the franking credits?
No, there's no franking credits, but it pays a supplementary dividend because it's New Zealand-based, so you get a credit for the tax they pay. Okay. But the good news about New Zealand is that a lot of their generation is actually renewable. It's one of the greenest energy producers in the world. In fact, Meridian's just going in some green index this week. A lot of their power comes from geothermal and hydro. Obviously, it rains a lot. They've got a lot of underground geothermal activity, and that generates very stable, predictable cash flows for those businesses. The good thing about Genesis is that they also have gas-fired power station, which gives them optionality. So obviously, when it doesn't rain, they need to generate an income stream from selling to the other utilities for generating electricity. And that's one of the things we think there's upside.
And what kind of dividend are we talking about from a company like Genesis?
As I said to you, Genesis is paying about a 9 to 10% yield at current price.
Gee, 9 to 10%. That sounds attractive. Even if they disappointed on the downside and halved it, it'd still be miles better than term deposits.
That's right, yeah.
All right, so they're 3 small cappers paying good dividends. Is there a small cap company you think that's been unfairly beaten up that, you mentioned SCA.
Yeah, look,
is there a classic one you think, gee, I backed it, Simon Conn's backed it, but the market's just been ridiculous?
Well, I think the one that really looks cheap at the moment, that's fallen precipitously, is Fletcher Building. It's not a small company. In fact, it's probably the largest building materials company in Australia and New Zealand. Very dominant position in New Zealand, but for whatever reason, it's fallen quite heavily. I think investors have taken a very negative view on the New Zealand and Australian construction cycle.
Yep.
It's been sold off to levels where it hasn't traded for many years. It's trading on a P of 11.5 times, yielding about 5.3% at the current prices. Looks very beaten up, very dominant position in New Zealand, and the government's continuing to roll out infrastructure projects in New Zealand.
Well, Simon, you've given us some fantastic ideas, and as always, thanks very much.
Okay, thanks.
Simon Conn from Investors Mutual. After break, let's find out the local story about the car rental business called Europe Car.